such operations should definitely be measured on the basis of several years. In a given year, they may produce nothing, as it is usually to our advantage to have the stock be stagnant market-wise for a long period while we are acquiring it. These situations, too, have relatively little in common with the behavior of the Dow. Sometimes, of course, we buy into a general with the thought in mind that it might develop into a control situation. If the price remains low enough for a long period, this might very well happen. Usually, it moves up before we have a substantial percentage of the company's stock, and we sell 36 at higher levels and complete a successful general operation. Dempster Mill Manufacturing Company. The high point of 1962 from a performance standpoint was our present control situation, 73% owned Dempster Mill. Dempster has been primarily in farm implements, mostly items retailing for $1,000 or under, water systems, water well supplies and jobbed plumbing lines. The operations for the past decade have been characterized by static sales, low inventory turnover and virtually no profits in relation to invested capital. We obtained control in August 1961 at an average price of about $28 per share, having bought some stock as low as $16 in earlier years, but the vast majority in an offer of $30.25 in August. When control of a company is obtained, obviously what then becomes all important is the value of assets, not the market quotation for a piece of paper, stock certificate. Last year, our Dempster holding was valued by applying what I felt were appropriate discounts to the various assets. These valuations were based on their status as non-earning assets and were not assessed on the basis of potential, but on the basis of what I thought a prompt sale would produce at that date. Our job was to compound these values at a decent rate. The consolidated balance sheet last year and the calculation of fair value are shown below. Omitted. Assets book figure valued at adjusted valuation liabilities cash $166,100 percent $166 notes payable $1,230 ACCTs. Rec. Net. $1,040 85% $884 other liabilities $1,088 inventory $4,203 60% $2,522 PPD. Express. Etc. $82 25% $21 current assets $5,491 $3,593 total liabilities $2,318 cash value life-ins, etc. $45,100 est.
Net auction value $45 net work per books. $4,601 net plant equipment $1,383 $800 net work as adjusted to quickly realizable values $2,120 total assets $6,919 $4,438 shares outstanding 60,146 AG.
Value per share $35.25. Dempster's fiscal year ends November 30th, and because the audit was unavailable in complete form, I approximated some of the figures and rounded to $35 per share last year. Initially, we worked with the old management toward more effective utilization of capital, better operating margins, reduction of overhead, etc. These efforts were completely fruitless. After spinning our wheels for about 6 months, it became obvious that while lip service was being given to our objective, either through inability or unwillingness, nothing was being accomplished. A change was necessary. A good friend, whose inclination is not toward enthusiastic descriptions, highly recommended Harry Bottle for 37-hour type of problem. On April 17, 1962, I met Harry in Los Angeles, presented a deal which provided for rewards to him based upon our objectives being met, and on April 23 he was sitting in the president's chair in Beatrice. Harry is unquestionably the man of the year. Every goal we have set for Harry has been met, and all the surprises have been on the pleasant side. He has accomplished one thing after another that has been labeled as impossible, and has always taken the tough things first. Our break-even point has been cut virtually in half, slow-moving or dead merchandise has been sold or written off, marketing procedures have been revamped, and unprofitable facilities have been sold. The results of this program are partially shown in the balance sheet below, which, since it still represents non-earning assets, is valued on the same basis as last year. Omitted. Assets book figure valued at adjusted valuation liabilities cash $60,100 $60 notes payable $0 marketable securities $758 market. December 31, $62,834 other liabilities $346 ACCTs. Rec. Net. $796 85% $676 total liabilities $346 inventory $1,634 60% $981 cash value life ins $41,100 $41 net worth recoverable income tax $170,100 $170 per books $4.077 ppd express etc. $14.25% $4 as adjusted to quickly realizable values $3.12 add. Proceeds from potential exercise of option to Harry Bottle $60 current assets $3,473 $2,766 shares outstanding 60,146 MISC. Invest. $5,100 $5 add. SHS. Potentially outstanding under option 2,000 total SHS. 62,146 net plant equipment $945 est. Net auction value $700 adjusted value per share $51.20 6 total assets $4,423 $3,471 3 facts stand out. 1. Although net worth has been reduced somewhat by the housecleaning and write-downs, $550,000 was written out of inventory. Fixed assets overall brought more than book value. We have converted assets to cash at a rate far superior to that implied in our year-earlier valuation. 2. To some extent, we have converted the assets from the manufacturing business, which has been a poor business, to a business which we think is a good business, securities. 3. By buying assets at a bargain price, we don't need to pull any rabbits out of a hat to get extremely good percentage gains. This is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. The better sales will be the frosting on the cake. 38 On January 2, 1963, Dempster received an unsecured term loan of $1,250,000. These funds, together with the funds already freed up, will enable us to have a security portfolio of about $35 per share at Dempster, are considerably more than we paid for the whole company. Thus our present valuation will involve a net of about $16 per share in the manufacturing operation and $35 in a security operation comparable to that of Buffett Partnership, Limited. We, of course, are devoted to compounding the $16 in manufacturing at an attractive rate and believe we have some good ideas as to how to accomplish this. While this will be easy if the business as presently conducted earns money, we have some promising ideas even if it shouldn't. It should be pointed out that Dempster last year was 100% an asset conversion problem and therefore, completely unaffected by the stock market and tremendously affected by our success with the assets. In 1963, the manufacturing assets will still be important, but from a valuation standpoint it will behave considerably more like a General since we will have a large portion of its money invested in Generals pretty much identical with those in Buffett Partnership, Limited. For tax reasons, we will probably not put workouts in Dempster. Therefore, if the Dow should drop substantially, it would have a significant effect on the Dempster valuation. Likewise, Dempster would benefit this year from an advancing Dow, which would not have been the case most of last year. There is one final point of real significance for Buffett Partnership, Limited. We now have a relationship with an operating man which could be of great benefit in future control situations. Harry had never thought of running an implement company 6 days before he took over. He is mobile, hard-working and carries out policies once they are set. He likes to get paid well for doing well, and I like dealing with someone who is not trying to figure how to get the fixtures in the executive washroom gold-plated. Harry and I like each other, and his relationship with Buffett Partnership, Limited, should be profitable for all of us. The question of conservatism, because I believe it may be even more meaningful after the events of 1962. I would like to repeat this section from last year's letter. The above description of our various areas of operation may provide some clues as to how conservatively our portfolio is invested. Many people some years back thought they were behaving in the most conservative manner by purchasing medium or long-term municipal or government bonds. This policy has produced substantial market depreciation in many cases, and most certainly has failed to maintain or increase real buying power. Conscious, perhaps overly conscious, of inflation, many people now feel that they are behaving in a conservative manner by buying blue-chip securities almost regardless of price-earnings ratios, dividend yields, etc. Without the benefit of hindsight, as in the bond example, I feel this course of action is fraught with danger. There is nothing at all conservative, in my opinion, about speculating as to just how high a multiplier a greedy and capricious public will put on earnings. You will not be right simply because a large number of people momentarily agree with you. You will not be right simply because important people agree with you. In many quarters, the simultaneous occurrence of the two above factors is enough to make a course of action meet the test of conservatism. You will be right, over the course of many transactions, if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. I might add that in no way does the fact that our portfolio is not conventional prove that we are more 39 conservative or less conservative than standard methods of investing. This can only be determined by examining the methods or examining the results. I feel the most objective test as to just how conservative our manner of investing is arises through evaluation of performance in down markets. Preferably these should involve a substantial decline in the Dow. Our performance in the rather mild declines of 1957 and 1960 would confirm my hypothesis that we invest in an extremely conservative manner. I would welcome any partners suggesting objective tests as to conservatism to see how we stack up. We have never suffered a realized loss of more than 0.5% of total net assets, and our ratio of total dollars of realized gains to total realized losses is something like 100 to 1. Of course, this reflects the fact that on balance we have been operating in an up market. However, there have been many opportunities for loss transactions even in markets such as these. You may have found out about a few of these yourselves, so I think the above facts have some significance. In 1962, we did realize a loss on one commitment or 1.0%, and our ratio or realized gains to losses was only slightly over 3 to 1. However, compared to more conventional, often termed conservative, which is not synonymous, methods of common stock investing, it would appear that our method involved considerably less risk. Our advantage over the Dow was all achieved when the market was going down. We lost a bit of this edge on the way up. The usual prediction: I am certainly not going to predict what general business or the stock market are going to do in the next year or two, since I don't have the faintest idea. I think you can be quite sure that over the next 10 years, there are going to be a few years when the general market is plus 20% or 25%, a few when it is minus on the same order, and a majority when it is in between. I haven't any notion as to the sequence in which these will occur, nor do I think it is of any great importance for the long-term investor. If you will take the first table on page 3 and shuffle the years around, the compounded result will stay the same. If the next 4 years are going to involve, say, a plus 40%, minus 30%, plus 10% and minus 6%, the order in which they fall is completely unimportant for our purposes as long as we all are around at the end of the 4 years. Over a long period of years, I think it likely that the Dow will probably produce something like 5% per year compounded from a combination of dividends and market value gain. Despite the experience of the last decade, anyone expecting substantially better than that from the general market probably faces disappointment. Our job is to pile up yearly advantages over the performance of the Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. I would consider a year in which we were down 15% and the Dow declined 25% to be much superior to a year when both the partnership and the Dow advanced 20%. For the reasons outlined in our method of operation, our best years relative to the Dow are likely to be in declining or static markets. Therefore, the advantage we seek will probably come in sharply varying amounts. There are bound to be years when we are surpassed by the Dow, but if over a long period we can average 10 percentage points per year better than it, I will feel the results have been satisfactory. Specifically, if the market should be down 35% or 40% in a year, and I feel this has a high probability of occurring 1 year in the next 10, no one knows which one, we should be down only 15% or 20%. If it is more or less unchanged during the year, we would hope to be up about 10 percentage points. If it is up 20% or more, we would struggle to be up as much. It is certainly doubtful we could match a 20% or 25% advance from the December 31, 1962 level. The consequence of performance such as this over a period of years would mean that if the Dow produces a 5% per year overall gain compounded, I would hope our results might be 15% per year.
40. The above expectations may sound somewhat rash, and there is no question but that they may appear very much so when viewed from the vantage point of 1965 or 1970.
Variations in any given year from the behavior described above would be wide, even if the long-term expectation was correct. Certainly, you have to recognize the possibility of substantial personal bias in such hopes. Miscellaneous this year marked the transition from the office off the bedroom to one quite a bit, more conventional. Surprising as it may seem, the return to a time clock life has not been unpleasant. As a matter of fact, I enjoy not keeping track of everything on the backs of envelopes. We are starting off this year with net assets of $9,405,400. At the start of 1962, Susie and I had 3 non-marketable security investments of other than nominal size, and 2 of these have been sold. The third will be continued indefinitely. From the proceeds of the 2 sales, we have added to our partnership interest so that we now have an interest of $1,377,400. Also, my 3 children, mother, father, 2 sisters, 2 brothers-in-law, father-in-law, 3 aunts, 4 cousins, 5 nieces and nephews have interests directly or indirectly totaling $893,600. Bill Scott, who has fit into our operation splendidly, has an interest, with his wife, of $167,400, a very large portion of his net worth. So we are all eating our own cooking. You will note from the auditor's certificate that they made a surprise check during the year, and this will be a continuing part of their procedure.
Pete, Marwick, Mitchell & Company again did an excellent job on the audit, meeting our rather demanding time schedules.
Susie was in charge of equipping the office, which means we did not follow my orange crate approach to interior decorating. We have an ample supply of Pepsi on hand and look forward to partners dropping in.
Beth Fian continues to demonstrate why she is the high priestess of the CPS, Certified Professional Secretary, that is, group.
Partners did a wonderful job of cooperating in the return of agreements and commitment letters, and I am most appreciative of this. It makes life a lot easier. Enclosed you will find Schedule A to your partnership agreement. You will be receiving your audit and tax figures very soon, and if you have questions on any of this, be sure to let me hear from you. Cordially, Warren E. Buffett 41 Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, July 10, 1963. First half performance. During the first half of 1963, the Dow Jones Industrial Average, hereinafter called the Dow, advanced from 652.10 to 706.88. If one had owned the Dow during this period, dividends of $10.66 would have been received, bringing the overall return from the Dow during the first half to plus 10.0%.
Our incantation has been 1. That short-term results, less than 3 years, have little meaning, particularly in reference to an investment operation such as ours that devotes a portion of resources to control situations, and 2. That our results relative to the Dow and other common stock form media will be better in declining markets and may well have a difficult time just matching such media in bubbling markets. Nevertheless, our first half performance, excluding any change in Dempster valuation, and its valuation did change, I'm saving this for dessert later in the letter, was plus 14%. This 14% is computed on total net assets, not non-Dempster assets, and is after expenses, but before monthly payments, to those who take them, to partners and allocation to the general partner. Such allocations are academic on an interim basis, but if we were also plus 14% at year-end, the first 6% would be allocated to partners according to their capital, plus 3/4 of the balance of 8%, 14% minus 6%, or an additional 6%, giving the limited partners a plus 12% performance. Despite the relatively pleasant results of the first half, the admonitions stated 2 paragraphs earlier hold in full force. At plus 14% versus plus 10% for the Dow, this 6 months has been a less satisfactory period than the first half of 1962, when we were minus 7.5% versus minus 21.7% for the Dow.
You should completely understand our thinking in this regard, which has been emphasized in previous letters. During the first half, we had an average net investment in generals, long positions in generals minus short positions in generals, of approximately $5,275,000. Our overall gain from this net investment in generals, for a description of our investment categories see the last annual letter, was about $1,100,000 for a percentage gain from this category of roughly 21%. This again illustrates the extent to which the allocation of our resources among various categories affects short-term results.
In 1962, the generals were down for the year, and only an outstanding performance by both of the other 2 categories, workouts and controls, gave us our unusually favorable results for that year.
Now this year, our workouts have done poorer than the Dow and have been a drag on performance, as they are expected to be in rising markets.
While it would be very nice to be 100% in generals in advancing markets and 100% in workouts in declining markets, I make no attempt to guess the course of the stock market in such a manner.
We consider all 3 of our categories to be good businesses on a long-term basis, although their short-term price behavior characteristics differ substantially in various types of markets. We consider attempting to gauge stock market fluctuations to be a very poor business on a long-term basis and are not going to be in it, either directly or indirectly, through the process of trying to guess which of our categories is likely to do best in the near future. Investment companies shown below are the usual statistics on a cumulative basis for the Dow and Buffett Partnership Limited, including predecessor partnerships, as well as for the 2 largest open-end mutual funds and 2 largest closed-end 42 investment companies following a diversified common stock investment policy. Year Dow Mass. INV. Trust. 1. Investors Stock. 1. Tricont. 2. 1957 minus 8.4% minus 11.4% minus 12.4% minus 2.4% 1957 58 26.9% 26.4% 29.2% 30.0% 1957 59 52.3% 37.8% 42.5% 40.9% 1957 to 60 42.9% 36.4% 41.6% 44.8% 1957 61 74.9% 71.3% 76.9% 77.4% 1957 62 61.6% 54.5% 53.2% 59.7% 1957 to 6 30/63 77.8% 72.4% 69.3% 75.7% annual compounded rate 9.3% 8.7% 8.4% 9.1% year Lehman 2 Partnership 3 Limited Partners 4 1957 11.4% 10.4% 9.3% 1957 58 24.7% 55.6% 44.5% 1957 59 34.8%, 95.9%, 74.7%, 1957, 60, 38.2%, 140.6%, 107.2%, 1957, 61, 70.8%, 251.0%, 181.6%, 1957, 62, 46.2%, 299.8%, 215.1%, 1957 to 6, 30/63, 60.8%, 355.8%, 252.9%, annual compounded rate 7.6%, 26.3%, 21.4%. Footnotes 1. Computed from changes in asset value plus any distributions to holders of record during year. 2. From 1963 Moody's Bank and Finance Manual for 1957 to 62. Estimated for first half 1963. 3. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout entire year after all expenses but before distributions to partners or allocations to the general partner. 4. For 1957 to 61 computed on basis of preceding column of partnership results allowing for allocation to general partner based upon present partnership agreement. The results continue to show that the most highly paid and respected investment advice has difficulty matching the performance of an unmanaged index of blue-chip stocks. This in no sense condemns these institutions or the investment advisors and trust departments whose methods, reasoning, and results largely parallel such investment companies. These media perform a substantial service to millions of investors in achieving adequate diversification, providing convenience and peace of mind, avoiding issues of inferior quality, etc. However, their services do not include, and in the great majority of cases, are not represented to include, the compounding of money at a rate greater than that achieved by the general market. Our partnership's fundamental reason for existence is to compound funds at a better than average rate with less exposure to long-term loss of capital than the above investment media. We certainly cannot represent that we will achieve this goal.
We can and do say that if we don't achieve this goal over any reasonable period excluding 43 an extensive speculative boom, we will cease operation. Dempster Mill Manufacturing Company. In our most recent annual letter, I described Harry Bottle as the man of the year.
If this was an understatement. Last year Harry did an extraordinary job of converting unproductive assets into cash which we then, of course, began to invest in undervalued securities. Harry has continued this year to turn underutilized assets into cash, but in addition, he has made the remaining needed assets productive. Thus we have had the following transformation in balance sheets during the last 19 months. November 30, 1961, omitted. Assets book figure valued at adjusted valuation liabilities cash $166,100%, $166 notes payable $1,230 ACCTs. Rec. Net. $1,040 85% $884 other liabilities $1,088 inventory $4,203 60% $2,522 PPD. Express. Etc.
$82 25% $21 total liabilities $2,318 current assets $5,491 $3,593 net worth. Per books $4,601 cash value life-ins, etc. $45,100% $45 as adjusted to quickly realizable values $2,120 net plant and equipment $1,383 est. Net auction value $800 total assets $6,919 $4,438 share outstanding $60,146. AGE. Value per share $35.25 44 November 30, 1962, omitted. Assets book figure valued at adjusted valuation liabilities cash $60,100% $60 notes payable $0 marketable securities $758 MKT. December 31, 62 $834 other liabilities $346 ACCTs.
Rec. Net. $796.85%, $676 total liabilities, $346 inventory, $1,634 60%, $981 cash value life-ins.
$41,100%, $41 net worth. Recoverable income tax $170,100%, $170 per books, $4,077 ppd.
Express.
Etc. $14.25%, $4 as adjusted to quickly realizable values, $3,125 add. Proceeds from potential exercise of option to Harry Bottle $60 current assets $3,473 $2,766 $3,185 shares outstanding 60,146 MISC.
Invest. $5,100% $5 add. SHS. Potentially outstanding under option. 2,000 total SHS. 62,146 net plant and equipment $945 est. Net auction value $700 AG.
Value per share $51.26 total assets $4,423 $3,471.45 November 30, 1963. Omitted. Assets book figure valued at adjusted valuation liabilities cash $144,100% $144 notes payable, paid 3 July 63. $125 marketable securities $1,772 MKT.
June 30, 63 $2,029 other liabilities $394 ACCTs. Rec. Net. $1,262 85% $1,073 total liabilities $519 inventory $977 60% $586 ppd. Express. Etc. $12.25% $3 net worth. Per books $4,582 current assets $4,167 $3,835 as adjusted to quickly realizable values $4,028 MISC. Invest $62,100% $62 shares outstanding 62,146 net plant and equip. $872 est. Net auction value $650 AG. Value per share $64.81 total assets $5,101 $4,547 I have included above the conversion factors we have previously used in valuing Dempster for BPL purposes to reflect estimated immediate sale values of non-earning assets. As can be seen, Harry has converted the assets at a much more favorable basis than was implied by my valuations. This largely reflects Harry's expertise and, perhaps, to a minor degree my own conservatism in valuation. As can also be seen, Dempster earned a very satisfactory operating profit in the first half, as well as a substantial unrealized gain in securities, and there is little question that the operating business, as now conducted, has at least moderate earning power on the vastly reduced assets needed to conduct it.
Because of a very important seasonal factor and also the presence of a tax carry forward, however, the earning power is not nearly what might be inferred simply by a comparison of the November 30, 62 and June 30, 63 balance sheets.
Partly because of this seasonality, but more importantly, because of possible developments in Dempster before 1963 year-end, we have left our Dempster holdings at the same $51.26 valuation used at year-end 1962 in our figures for BPL's first half. However, I would be very surprised if it does not work out higher than this figure at year-end. One sidelight for the fundamentalists in our group. BPL owns 71.7% of Dempster acquired at a cost of $1,262,577.27. On June 30, 1963 Dempster had a small safe deposit box at the Omaha National Bank containing securities worth $2,028,415.25. Our 71.7% share of $2,028,415.25 amounts to $1,454,373.70. Thus, everything above ground, and part of it underground, is profit. My security analyst friends may find this a rather primitive method of accounting, but I must confess that I find a bit more substance in this fingers and toes method than in any prayerful reliance that someone will pay me 35 times next year's earnings. 46 Advance payments and advance withdrawals. We accept advance payments from partners and prospective partners at 6% interest from date of receipt until the end of the year. While there is no obligation to convert the payment to a partnership interest at the end of the year, this should be the intent at the time of payment. Similarly, we allow partners to withdraw up to 20% of their partnership account prior to year-end and charge them 6% from date of withdrawal until year-end, when it is charged against their capital account. Again, it is not intended that partners use US like a bank, but that they use the withdrawal right for unanticipated need for funds. The willingness to both borrow and lend at 6% may seem un-Buffett-like. We look at the withdrawal right as a means of giving some liquidity for unexpected needs and, as a practical matter, are reasonably sure it will be far more than covered by advance payments.
Why then the willingness to pay 6% for advance payment money when we can borrow from commercial banks at substantially lower rates?
For example, in the first half we obtained a substantial 6-month bank loan at 4%.
The answer is that we expect on a long-term basis to earn better than 6%. The general partner's allocation is 0 unless we do, although it is largely a matter of chance whether we achieve the 6% figure in any short period.
Moreover, I can adopt a different attitude in the investment of money that can be expected to soon be a part of our equity capital than I can on short-term borrowed money. The advance payments have the added advantage to us of spreading the investment of new money over the year, rather than having it hit us all at once in January. On the other hand, 6% is more than can be obtained in short-term dollar-secure investments by our partners, so I consider it mutually profitable. On June 30, 1963, we had advance withdrawals of $21,832 and advance payments of $562,437.11. Taxes. There is some possibility that we may have fairly substantial realized gains this year. Of course, this may not materialize at all and actually does not have anything to do with our investment performance this year.
I am an outspoken advocate of paying large amounts of income taxes at low rates. A tremendous number of fuzzy, confused investment decisions are rationalized through so-called tax considerations. My net worth is the market value of holdings less the tax payable upon sale.
The liability is just as real as the asset unless the value of the asset declines. Ouch. The asset is given away, no comment, or I die with it. The latter course of action would appear to at least border on a Pyrrhic victory. Investment decisions should be made on the basis of the most probable compounding of after-tax net worth with minimum risk. Any isolation of low-basis securities merely freezes a portion of net worth at a compounding factor identical with the assets isolated. While this may work out either well or badly in individual cases, it is a nullification of investment management. The group experience holding various low-basis securities will undoubtedly approximate group experience on securities as a whole, namely compounding at the compounding rate of the Dow. We do not consider this the optimum in after-tax compounding rates. I have said before that if earnings from the partnership can potentially amount to a sizable portion of your total taxable income, the safe thing to do is to estimate this year the same tax you incurred last year. If you do this, you cannot run into penalties. In any event, tax liabilities for those who entered the partnership on the 1st of January 63 will be minimal because of the terms of our partnership agreement first allocating capital gains to those having an interest in unrealized appreciation. 47 As in past years, we will have a letter out about November 1st, to partners and those who have indicated an interest to me by that time in becoming partners, with the amendment to the partnership agreement, commitment letter for 1964, estimate of the 1963 tax situation, etc. My closing plea for questions regarding anything not clear always draws a blank. Maybe no one reads this far. Anyway, the offer is still open. Cordially, Warren E. Buffett 48 Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, November 6, 1963. To my partners for 1964. Enclosed is the usual assortment of Thanksgiving reading material. 1. 2 copies of an amended partnership agreement for 1964. The one with the general provisions attached is to be kept by you, exactly the same as last year, and the other single-page agreement is to be signed, notarized and returned to us. Partners in Omaha may come in and obtain the notarization at our office. 2. A copy of that priceless treatise, The Ground Rules. I would like every partner to read this at least once a year, and it is going to be a regular item in my November package. Don't sign the partnership agreement unless you fully understand the concepts set forth and are in accord with them, mentally and viscerally. 3. 2 copies of the commitment letter for 1964, one to be kept by you and one returned to us. You may amend this commitment letter right up to midnight, December 31st, so get it back to us early, and if it needs to be changed, just let us know by letter or phone. Any withdrawals will be paid immediately after January 1st. You may withdraw any amount you desire from $100 up to your entire equity. Similarly, additions can be for any amount and should reach us by January 10th. In the event you are disposing of anything, this will give you a chance to have the transaction in 1964 if that appears to be advantageous for tax reasons. If additions reach us in November, they take on the status of advance payments and draw interest at the rate of 6% until year-end. This is not true of additions reaching us in December. Complete tax information for your 1963 return will be in your hands by January 25th. If you should need an estimate of your tax position before that time, let me know and I will give you a rough idea. We will also send out a short letter on taxes in late December. At the end of October, the overall result from the Dow for 1963 was plus 18.8%. We have had a good year in all 3 categories: generals, workouts and controls. A satisfactory sale on a going concern basis of Dempster Mill Manufacturing operating assets was made about a month ago. I will give the full treatment to the Dempster story in the annual letter, perhaps climaxed by some lyrical burst such as Ode to Harry Bottle. While we always had a built-in profit in Dempster because of our bargain purchase price, Harry accounted for several extra servings of dessert by his extraordinary job. Harry, incidentally, has made an advance payment toward becoming a limited partner in 1964. We consider this the beginning, not the end. However, 1963 has not been all Dempster. While a great deal can happen the last 2 months and therefore interim results should not be taken too seriously, at the end of October the overall gain for the partnership was about 32%. Based on the allocation embodied in our agreement, this works out to plus 25.5% for the limited partners before monthly payments to those who take them. Of our approximate $3 million gain, something over $2 million came from marketable securities and a little less than $1 million from Dempster operating assets. The combined gain from our single best general and best workout situation approximated the gain on the Dempster operating assets. 49. You should be aware that if our final results relative to the Dow for 1963 are as favorable as on October 31st, I will regard it as an abnormal year. I do not consider a 13.2 percentage point margin to be in the cards on a long-term basis. A considerably more moderate annual edge over the Dow will be quite satisfactory. Cordially, Warren E. Buffett P.S. Last year we announced there would be no prizes for the last ones to get the material back to us. This continues to be our policy. Save us some last-minute scurrying by getting your agreement and commitment letter back pronto. Give Bill or me a call if we can be of any help. Thanks. 50 Buffett Partnership, Limited.
810 Kiewit Plaza, Omaha 31, Nebraska, January 18, 1964. Our performance in 1963 1963 was a good year.
It was not a good year because we had an overall gain of $3,637,167 or 38.7% on our beginning net assets, pleasant as that experience may be to the pragmatists in our group. Rather, it was a good year because our performance was substantially better than that of our fundamental yardstick, the Dow Jones Industrial Average, hereinafter called the Dow.
If we had been down 20% and the Dow had been down 30%, this letter would still have begun. 1963 was a good year. Regardless of whether we are plus or minus in a particular year, if we can maintain a satisfactory edge on the Dow over an extended period of time, our long-term results will be satisfactory, financially as well as philosophically.
To bring the record up to date, the following summarizes the year-by-year performance of the Dow, the performance of the partnership before allocation to the general partner, and the limited partner's results for all full years of BPL's and predecessor partnerships' activities. Year overall results from Dow. 1. Partnership results. 2. Limited partners results. 3. 1957. 8.4%, 10.4%, 9.3%, 1958, 38.5%, 40.9%, 32.2%, 1959, 20.0%, 25.9%, 20.9%, 1960 minus 6.2%, 22.8%, 18.6%, 1961, 22.4%, 45.9%, 35.9%, 1962 minus 7.6%, 13.9%, 11.9%, 1963 20.7%, 38.7%, 30.5%. 1. Based on yearly changes in the value of the Dow plus dividends that would have been received through ownership of the Dow during that year. 2. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout the entire year after all expenses but before distributions to partners or allocations to the general partner. 3. For 1957 to 61 computed on the basis of the preceding column of partnership results allowing for allocation to the general partner based upon the present partnership agreement.
One wag among the limited partners has suggested I add a fourth column showing the results of the general partner. Let's just say he, too, has an edge on the Dow.
The following table shows the cumulative or compounded results based on the preceding table. Year overall results from Dow Partnership results limited partners results 1957 minus 8.4%, 10.4%, 9.3%, 1957, 58. 26.9%, 55.6%, 44.5%, 1957, 59, 52.3%, 95.9%, 74.7%, 51, 1957, 60 42.9%, 140.6%, 107.2%, 1957, 61, 74.9%, 251.0%, 181.6%, 1957, 62, 61.6%, 299.8%, 215.1%, 1957, 63, 95.1%, 454.5%, 311.2%, annual compounded rate 10.0%, 27.7%, 22.3%. It appears that we have completed 7 fat years. With apologies to Joseph, we shall attempt to ignore the biblical script.
I've never gone overboard for No's ideas on diversification either. In a more serious vein, I would like to emphasize that, in my judgment, our 17.7 margin over the Dow shown above is unattainable over any long period of time.
A 10 percentage point advantage would be a very satisfactory accomplishment, and even a much more modest edge would produce impressive gains, as will be touched upon later. This view, and it has to be guesswork, informed or otherwise, carries with it the corollary that we must expect prolonged periods of much narrower margins over the Dow, as well as at least occasional years when our record will be inferior, perhaps substantially so, to the Dow. Much of the above sermon is reflected in the ground rules sent to everyone in November, but it can stand repetition.
Investment companies. We regularly compare our results with the 2 largest open-end investment companies, mutual funds, that follow a policy of being, typically, 95 to 100% invested in common stocks, and the two largest diversified closed-end investment companies.
These four companies, Massachusetts Investors Trust, Investors Stock Fund, Tricontinental Corp., and Lehman Corp.,
manage about $4 billion and are probably typical of most of the $25 billion investment company industry.
My opinion is that their results roughly parallel those of the vast majority or other investment advisory organizations which handle, in aggregate, vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index or investment achievement.
The advisory talent managing just the four companies shown commands annual fees of over $7 million, and this represents a very small fraction of the industry.
The public batting average of this highly paid talent indicates they achieved results slightly less favorable than the Dow. Both our portfolio and method of operation differ substantially from the investment companies in the table. However, most partners, as an alternative to their interest in the partnership, would probably have their funds invested in media producing results comparable with investment companies, and I, therefore, feel they offer a meaningful standard of performance. Yearly results. Year Mass. INV. Trust. 1. Investors Stock. 1. Lehman. 2. Tricont. 2. Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1958 42.7% 47.5% 40.8% 33.2% 38.5% 32.2% 1959 9.0% 10.3% 8.1% 8.4%, 20.0%, 20.9%, 1960 -1.0%, -0.6%, 2.5%, 2.8%, -6.2%, 18.6%, 1961 25.6%, 24.9%, 23.6%, 22.5%, 22.4%, 35.9%, 1962 -9.8%, -13.4%, -14.4%, -10.0%, -7.6%, 11.9%, 1963 20.0%, 16.5%, 23.8%, 19.5%, 20.7%, 30.5%, 52. 1. Computed from changes in asset value plus any distributions to holders of record during year. 2. From 1963 Moody's Bank and Finance Manual for 1957 to 62, estimated for 1963. Compounded year Mass. INV. Trust Investors Stock Lehman Tricont. Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1957 58 26.4% 29.2% 24.7% 30.0% 26.9% 44.5% 1957 59 37.8%, 42.5%, 34.8%, 40.9%, 52.3%, 74.7%, 1957 to 60, 36.4%, 41.6%, 38.2%, 44.8%, 42.9%, 107.2%, 1957. 61. 71.3%, 76.9%, 70.8%, 77.4%, 74.9%, 181.6%, 1957. 62. 54.5%, 53.2%, 46.2%, 59.7%, 61.6%, 215.1%, 1957 to 63, 85.4%, 78.5%, 81.0%, 90.8%, 95.1%, 311.2%, annual compounded rate 9.2%, 8.6%, 8.8%, 9.7%, 10.0%, 22.3%. The Dow, of course, is an unmanaged index, and it may seem strange to the reader to contemplate the high priests of Wall Street striving vainly to surpass or even equal it. However, this is demonstrably the case. Moreover, such a failure cannot be rationalized by the assumption that the investment companies at all are handling themselves in a more conservative manner than the Dow. As the table above indicates, and as more extensive studies bear out, the behavior of common stock portfolio managed by this group, on average, have declined in concert with the Dow. By such a test of behavior in declining markets, our own methods of operation have proven to be considerably more conservative than the common stock component of the investment company or investment advisor group. While this has been true in the past, there obviously can be no guarantees about the future. The above may seem like rather strong medicine, but it is offered as a factual presentation and in no way as criticism. Within their institutional framework and handling the many billions of dollars involved, the results achieved are the only ones attainable. To behave unconventionally within this framework is extremely difficult. Therefore, the collective record of such investment media is necessarily tied to the record of corporate America. Their merits, except in the unusual case, do not lie in superior results or greater resistance to decline in value. Rather, I feel they earn their keep by the ease of handling, the freedom from decision-making and the automatic diversification they provide, plus, perhaps most important, the insulation afforded from temptation to practice patently inferior techniques which seem to entice so many world-B investors. The joys of compounding now to the pulse-quickening portion of our essay. Last year, in order to drive home the point on compounding, I took a pot shot at Queen Isabella and her financial advisors. You will remember they were euchred into such an obviously low compound situation as the discovery of a new hemisphere. Since the whole subject of compounding has such a crass ring to it, I will attempt to introduce a little class into this discussion by turning to the art world. Francis I of France paid 4,000 écus in 1540 for Leonardo da Vinci's Mona Lisa. On the off chance that a few of you have not kept track of the fluctuations of the écu, 4,000 converted out to about $20,000. If Francis had kept his feet on the ground and he, and his trustees, had been able to find a 6% after-tax 53 investment, the estate now would be worth something over $1 quadrillion. That's $1 quadrillion or over 3,000 times the present national debt, all from 6%. I trust this will end all discussion in our household about any purchase or paintings qualifying as an investment. However, as I pointed out last year, there are other morals to be drawn here. One is the wisdom of living a long time. The other impressive factor is the swing produced by relatively small changes in the rate of compound.
Below are shown the gains from $100,000 compounded at various rates: 4%, 8%, 12%, 16%, 10 years, $48,024, $115,892, $210,584, $341,143, 20 years, $119,111, $366,094, $864,627, $1,846,060, 30 years, $224,337, $906,260, $2,895,970, $8,484,940. It is obvious that a variation of merely a few percentage points has an enormous effect on the success of a compounding investment program.
It is also obvious that this effect mushrooms as the period lengthens. If, over a meaningful period of time, Buffett Partnership can achieve an edge of even a modest number of percentage points over the major investment media, its function will be fulfilled. Some of you may be downcast because I have not included in the above table the rate of 22.3% mentioned on page 3. This rate, of course, is before income taxes which are paid directly by you, not the partnership. Even excluding this factor, such a calculation would only prove the absurdity of the idea of compounding at very high rates, even with initially modest sums. My opinion is that the Dow is quite unlikely to compound for any important length of time at the rate it has during the past 7 years and, as mentioned earlier, I believe our margin over the Dow cannot be maintained at its level to date. The product of these assumptions would be a materially lower average rate of compound for BPL in the future than the rate achieved to date. Injecting a -30% year, which is going to happen from time to time, into our tabulation of actual results to date, with, say, a corresponding -40% for the Dow brings both the figures on the Dow and BPL more in line with longer-range possibilities. As the compounding table above suggests, such a lowered rate can still provide highly satisfactory long-term investment results. Our method of operation at this point I always develop literary schizophrenia. On the one hand, I know that we have in the audience a number of partners to whom details of our business are interesting. We also have a number to whom this whole thing is Greek and who undoubtedly wish I would quit writing and get back to work. To placate both camps, I am just going to sketch briefly our 3 categories at this point, and those who are interested in getting their doctorate can refer to the appendix for extended treatment of examples. Our 3 investment categories are not differentiated by their expected profitability over an extended period of time. We are hopeful that they will each, over a 10 or 15-year period, produce something like the 10 percentage point margin over the Dow that is our goal. However, in a given year they will have violently different behavior characteristics, depending primarily on the type of year it turns out to be for the stock market generally. Briefly, this is how they shape up. Generals, a category of generally undervalued stocks, determined primarily by quantitative standards, but with considerable attention also paid to the qualitative factor. There is often little or nothing to indicate immediate market improvement. The issues lack glamour or market sponsorship. Their main qualification is a bargain price. That is, an overall valuation on the enterprise substantially below what careful analysis indicates its value to a private owner to be. Again, let me emphasize that 54, while the quantitative comes first and is essential, the qualitative is important. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dormant management or stockholder group. But we demand value. The general group behaves very much in sympathy with the Dow and will turn in a big minus result during a year of substantial decline by the Dow. Contrariwise, it should be the star performer in a strongly advancing market. Over the years we expect it, of course, to achieve a satisfactory margin over the Dow. Workouts, these are the securities with a timetable. They arise from corporate activity, sell-outs, mergers, reorganizations, spin-offs, etc. In this category we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activities of this sort. We wait until we can read it in the paper. The risk pertains not primarily to general market behavior, although that is sometimes tied in to a degree, but instead to something upsetting the applecart so that the expected development does not materialize. Such killjoys could include antitrust or other negative government action, stockholder disapproval, withholding of tax rulings, etc. The gross profits in many workouts appear quite small. A friend refers to this as getting the last nickel after the other fellow has made the first 95 cents. However, the predictability coupled with a short holding period produces quite decent annual rates of return. This category produces more steady absolute profits from year to year than generals do. In years of market decline, it piles up a big edge for us. During bull markets, it is a drag on performance. On a long-term basis, I expect it to achieve the same sort of margin over the Dow attained by generals. Controls, these are rarities, but when they occur they are likely to be of significant size. Unless we start off with the purchase of a sizable block or stock, controls develop from the general category. They result from situations where a cheap security does nothing price-wise for such an extended period of time that we are able to buy a significant percentage of the company's stock. At that point, we are probably in a position to assume some degree of, or perhaps complete, control of the company's activities. Whether we become active or remain relatively passive at this point depends upon our assessment of the company's future and the management's capabilities. The general we have been buying the most aggressively in recent months possesses excellent management following policies that appear to make very good sense to us. If our continued buying puts us in a controlling position at some point in the future, we will probably remain very passive regarding the operation or this business. We do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings. Active or passive, in a control situation there should be a built-in profit. The sine qua non of this operation is an attractive purchase price. Once control is achieved, the value of our investment is determined by the value of the enterprise, not the oftentimes irrationalities of the marketplace. Our willingness and financial ability to assume a controlling position gives us two-way stretch on many purchases in our group of generals. If the market changes its opinion for the better, the security will advance in price. If it doesn't, we will continue to acquire stock until we can look to the business itself rather than the market for vindication of our judgment. Investment results in the control category have to be measured on the basis of at least several years. Proper buying takes time.
If needed, strengthening management, redirecting the utilization of capital, perhaps effecting a satisfactory sale or merger, etc., are also all factors that make this a business to be measured in years rather than months.
For this reason, in controls, we are looking for wide margins of profit. If it looks at all close, we pass. 55 controls in the buying stage move largely in sympathy with the Dow. In the later stages, their behavior is geared more to that of workouts.
As I have mentioned in the past, the division of our portfolio among the three categories is largely determined by the accident or availability.
Therefore, in a minus year for the Dow, whether we are primarily in generals or workouts is largely a matter of luck, but it will have a great deal to do with our performance relative to the Dow. This is one or many reasons why a single year's performance is of minor importance and, good or bad, should never be taken too seriously.
If there is any trend as our assets grow, I would expect it to be toward controls, which heretofore have been our smallest category.
I may be wrong in this expectation. A great deal depends, of course, on the future behavior of the market, on which your guess is as good as mine. I have none. At this writing, we have a majority of our capital in generals, workouts rank second, and controls are third. Miscellaneous, we are starting off the year with net assets of $17,454,900. Our rapid increase in assets always raises the question of whether this will result in a dilution of future performance. To date, there is more of a positive than inverse correlation between size of the partnership and its margin over the Dow. This should not be taken seriously, however. Larger sums may be an advantage at some times and a disadvantage at others. My opinion is that our present portfolio could not be improved if our assets were $1 million or $5 million. Our idea inventory has always seemed to be 10% ahead of our bank account. If that should change, you can count on hearing from me. Susie and I have an investment of $2,392,900 in the partnership. For the first time, I had to withdraw funds in addition to my monthly payments, but it was a choice of this or disappointing the Internal Revenue Service. Susie and I have a few non-marketable, less than 300 holders, securities of nominal size left over from earlier years, which in aggregate are worth perhaps 1% of our partnership interest. In addition, we have one non-marketable holding of more material size of a local company purchased in 1960, which we expect to hold indefinitely. Aside from this, all our eggs are in the BPL basket, and they will continue to be. I can't promise results, but I can promise a common destiny. In addition, that endless stream of relatives of mine consisting of my 3 children, mother, father, 2 sisters, 2 brothers-in-law, father-in-law, 4 aunts, 4 cousins and 5 nieces and nephews, have interests in BPL directly or indirectly totaling $1,247,190. Bill Scott is also in with both feet, having an interest along with his wife for $237,400, the large majority are their net worth. Bill has done an excellent job and on several or our more interesting situations going into 1964, he has done the majority or the contact work. I have also shoved off on him as much as possible of the administrative work, so if you need anything done or have any questions, don't hesitate to ask for Bill if I'm not around. Beth and Donna have kept an increasing workload flowing in an excellent manner. During December and January, I am sure they wish they had found employment elsewhere, but they always manage to keep a mountain of work shipshape. Pete, Marwick, Mitchell has done their usual excellent job of meeting a tough timetable. We have instructed them to conduct 2 surprise checks a year, rather than one as in past years, on our securities, cash, etc., in the future. These are relatively inexpensive, and I think make a good deal of sense in any financial organization. Within the next week you will receive 1. A tax letter giving you all BPL information needed for your 1963 federal income tax return. This letter 56 is the only item that counts for tax purposes. 2. An audit from Pete, Marwick, Mitchell & Company for 1963, setting forth the operations and financial position of BPL as well as your own capital account. 3. A letter signed by me setting forth the status of your BPL interest on the 1st of January 64. This is identical with the figure developed in the audit. 4. Schedule A to the partnership agreement listing all partners. Let me know if anything needs clarifying. As we grow, there is more chance of missing letters, a name skipped over, a figure transposition, etc., so speak up if it appears we might have erred. Our next Appendix Texas National Petroleum. This situation was a run-of-the-mill workout arising from the number one source of workouts in recent years, the sellouts of oil and gas producing companies. TNP was a relatively small producer with which I had been vaguely familiar for years. Early in 1962 I heard rumors regarding a sellout to Union Oil of California. I never act on such information, but in this case it was correct and substantially more money would have been made if we had gone in at the rumor stage rather than the announced stage. However, that's somebody else's business, not mine. In early April, 1962, the general terms of the deal were announced. TNP had 3 classes of securities outstanding. 1, 6.5% debentures callable at 104 1/4, which would bear interest until the sale transpired and at that time would be called. There were $6.5 million outstanding, of which we purchased $264,000 principal amount before the sale closed. 2. About 3.7 million shares of common stock, of which the officers and directors owned about 40%. The proxy statement estimated the proceeds from the liquidation would produce $7.42 per share. We purchased 64,035 shares during the 6 months or so between announcement and closing. 3. 650,000 warrants to purchase common stock at $3.50 per share. Using the proxy statement estimate of $7.42 for the workout on the common resulted in $3.92 as a workout on the warrants. We were able to buy 83,200 warrants, or about 13% of the entire issue, in 6 months. The risk of stockholder disapproval was nil. The deal was negotiated by the controlling stockholders, and the price was a good one. Any transaction such as this is subject to title searches, legal opinions, etc., but this risk could also be appraised at virtually nil. There were no antitrust problems. This absence of legal or antitrust problems is not always the case, by any means. The only fly in the ointment was the obtaining of the necessary tax ruling. Union Oil was using a standard ABC production payment method of financing. The University of Southern California was the production payment holder, and there was some delay because of their eleemosynary status. This posed a new problem for the Internal Revenue Service, But we understood USC was willing to waive this status, which still left them with a satisfactory profit after they borrowed all the money from a bank. While getting this ironed out created delay, it did not threaten the deal. When we talked with the company on April 23 and 24, their estimate was that the closing would take place in August or September. The proxy material was mailed May 9 and stated the sale will be consummated during the summer of 1962 and that within a few months thereafter the greater part of the proceeds will be distributed to stockholders in liquidation. As mentioned earlier, the estimate was $7.42 per share. Bill Scott attended the stockholders' meeting in Houston on May 29, where it was stated they still expected to close on September 1. The following are excerpts from some of the telephone conversations we had with company officials in ensuing months. 58 On June 18, the secretary stated, "Union has been told a favorable IRS ruling has been formulated but must be passed on by additional IRS people. Still hoping for ruling in July." On July 24, the president said that he expected the IRS ruling early next week. On August 13, the treasurer informed us that the TNP, Union Oil, and USC people were all in Washington attempting to thrash out a ruling. On September 18, the treasurer informed us, "No news, although the IRS says the ruling could be ready by next week." The estimate on payout was still $7.42. The ruling was received in late September, and the sale closed October 31. Our bonds were called November 13. We converted our warrants to common stock shortly thereafter and received payments on the common of $3.50 December 14, 1962, $3.90 February 4, 1963, and 15 cents on April 24, 1963. We will probably get another 4 cents in a year or two. On 147,235 shares, after exercise of warrants, even 4 cents per share is meaningful. This illustrates the usual pattern. 1. The deals take longer than originally projected, and 2. The payouts tend to average a little better than estimates. With TNP it took a couple of extra months, and we received a couple of extra %. The financial results of TNP were as follows. 1. On the bonds we invested $260,773 and had an average holding period of slightly under 5 months. We received 6.5% interest on our money and realized a capital gain of $14,446. This works out to an overall rate of return of approximately 20% per annum. 2. On the stock and warrants we have realized capital gain of $89,304. And we have stubs presently valued at $2,946. From an investment or $146,000 in April, our holdings ran to $731,000 in October. Based on the time the money was employed, the rate or return was about 22% per annum. In both cases, the return is computed on an all-equity investment. I definitely feel some borrowed money is warranted against a portfolio of workouts, but feel it is a very dangerous practice against generals. We are not presenting TNP as any earth-shaking triumph. We have had workouts which were much better and some which were poorer. It is typical of our bread and butter type of operation. We attempt to obtain all facts possible, continue to keep abreast of developments and evaluate all of this in terms of our experience. We certainly don't go into all the deals that come along. There is considerable variation in their attractiveness. When a workout falls through, the resulting market value shrink is substantial. Therefore, you cannot afford many errors, although we fully realize we are going to have them occasionally. Dempster Mill MFG. This situation started as a general in 1956. At that time the stock was selling at $18 with about $72 in book value, of which $50 per share was in current assets, cash, receivables and inventory, less all liabilities. Dempster had earned good money in the past but was only breaking even currently. The qualitative situation was on the negative side, a fairly tough industry and unimpressive management, but the figures were extremely attractive. Experience shows you can buy 100 situations like this and have perhaps 70 or 80 work out to reasonable profits in 1 to 3 years. Just why any particular one should do so is hard to 59 say at the time of purchase, but the group expectancy is favorable, whether the impetus is from an improved industry situation, a takeover offer, a change in investor psychology, etc. We continued to buy the stock in small quantities for 5 years. During most of this period I was a director and was becoming consistently less impressed with the earnings prospects under existing management. However, I also became more familiar with the assets and operations, and my evaluation of the quantitative factors remained very favorable. By mid-1961 we owned about 30% of Dempster. We had made several tender offers with poor results, but in August and September 1961 made several large purchases at $30.25 per share, which coupled with a subsequent tender offer at the same price, brought our holding to over 70%. Our purchases over the previous 5 years had been in the $16 to $25 range. On assuming control, we elevated the executive vice president to president to see what he would do unfettered by the previous policies. The results were unsatisfactory, and on April 23, 1962 we hired Harry Bottle as president. Harry was the perfect man for the job. I have recited his triumphs before, and the accompanying comparative balance sheets speak louder than any words in demonstrating the re-employment of capital. November 30, 61, July 31, 63. Unaudited, cash $166,000, $89,000 U.S. Govt securities. At cost $289,000 other marketable securities. At market, which exceeds cost, $2,049,000 total cash and securities $166,000 $2,436,000 accounts receivable, net, $1,040,000 $864,000 inventory $4,203,000 $890,000 prepaid expenses, etc. $82,000 $12,000 current assets $5,491,000 $4,202,000 other assets $45,000 $62,000 net plant and equipment $1,383,000 $862,000 total assets $6,919,000 $5,126,000 notes payable $1,230,000 other liability $1,088,000 $274,000 total liabilities $2,318,000 $274,000 net worth $60,146 SHS. November 30, 61 $62,146 SHS. July 31, 63 $4,601,000 $4,852,000 total liabilities and net worth $6,919,000 $5,126,000 Harry 1. Took the inventory from over $4 million, much of it slow-moving, to under $1 million, reducing carrying costs and obsolescence risks tremendously. 2. Correspondingly freed up capital for marketable security purchases from which we gained over $6,400,000. 3. Cut administration and selling expense from $150,000 to $75,000 per month. 4. Cut factory overhead burden from $6 to $4.50 per direct labor hour. 5. Closed the 5 branches operating unprofitably, leaving us with 3 good ones, and replaced them with more productive distributors. 6. Cleaned up a headache at an auxiliary factory operation at Columbus, Nebraska. 7. Eliminated jobbed lines tying up considerable money, which could be used profitably in securities, while producing no profits. 8. Adjusted prices of repair parts, thereby producing an estimated $200,000 additional profit with virtually no loss of volume. And most important. 9. Through these and many other steps, restored the earning capacity to a level commensurate with the capital employed. In 1963, the heavy corporate taxes we were facing, Harry surprised me by the speed with which he had earned up our tax loss carry forward, coupled with excess liquid funds within the corporation compelled us to either in some way to incorporate or to sell the business. We set out to do either one or the other before the end of 1963. Incorporating had many problems but would have, in effect, doubled earnings for our partners and also eliminated the problem of corporate capital gain tax on Dempster securities. At virtually the last minute, After several earlier deals had fallen through at reasonably advanced stages, a sale of assets was made. Although there were a good many wrinkles to the sale, the net effect was to bring approximately book value. This, coupled with the gain we have in our portfolio of marketable securities, gives us a realization of about $80 per share. Dempster, now named First Beatrice Corp. We sold the name to the new co. Is down to almost entirely cash and marketable securities now. On BPL's year-end audit, our First Beatrice holdings were valued at asset value, with securities at market, less a $200,000 reserve for various contingencies. I might mention that we think the buyers will do very well with Dempster. They impress us as people of ability and they have sound plans to expand the business and its profitability. We would have been quite happy to operate Dempster on an unincorporated basis, but we are also quite happy to sell it for a reasonable price. Our business is making excellent purchases, not making extraordinary sales. Harry works the same way I do. He likes big carrots. He is presently a limited partner of BPL, and the next belt-tightening operation we have, he's our man. The Dempster saga points up several morals. 1. Our business is one requiring patience. It has little in common with a portfolio of high-flying glamour stocks, and during periods of popularity for the latter, we may appear quite stodgy. It is to our advantage to have securities do nothing price-wise for months, or perhaps years, why we are buying them. This points up the need to measure our results over an adequate period of time. We 61 suggest 3 years as a minimum. 2. We cannot talk about our current investment operations. Such an open-mouth policy could never improve our results and in some situations could seriously hurt us. For this reason, should anyone, including partners, ask us whether we are interested in any security, we must plead the Fifth Amendment. 62 Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, July 8, 1964. First half performance. The whole family is leaving for California on June 23, so I am fudging a bit on this report and writing it June 18. However, for those of you who set your watches by the receipt of our letters, I will maintain our usual chronological symmetry in reporting, leaving a few blanks which Bill will fill in after the final June 30 figures are available. During the first half of 1964, the Dow Jones Industrial Average, hereinafter called the Dow, advanced from 762.95 to 831.50. If one had owned the Dow during this period, dividends of approximately 14.40 would have been received, bringing the overall return from the Dow during the first half to plus 10.0%. As I write this on June 18, it appears that our results will differ only insignificantly from those of the Dow. I would feel much better reporting to you that the Dow had broken even, and we had been plus 5%, or better still, that the Dow had been minus 10%, and we had broken even. I have always pointed out, however, that gaining an edge on the Dow is more difficult for us in advancing markets than in static or declining ones. To bring the record up to date, the following summarizes the performance of the Dow, the performance of the partnership before allocation to the general partner and the limited partners results. Year overall results from Dow. 1. Partnership results. 2. Limited partners results. 3. 1957. 8.4%, 10.4%, 9.3%, 1958, 38.5%, 40.9%, 32.2%, 1959, 20.0%, 25.9%, 20.9%, 1960 minus 6.2%, 22.8%, 18.6%, 1961, 22.4%, 45.9%, 35.9%, 1962 minus 7.6%, 13.9%, 11.9%, 1963, 20.6%, 38.7%, 30.5%, first half 1964, 10.9%, 12.0%, 10.5%, cumulative results 116.1%, 521.0%, 354.4%, annual compounded rate rate 10.8%, 27.6%, 22.2%. See next page for footnotes to table. Footnotes to preceding table. 1. Based on yearly changes in the value of the Dow plus dividends that would have been received through ownership of the Dow during that year. The table includes all complete years of partnership activity. 2. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout the entire year after all expenses but before distributions to partners or allocations to the general partner. 3. For 1957 to 61 computed on the basis of the preceding column of partnership results allowing for 63 allocation to the general partner based up on the present partnership agreement, but before monthly withdrawals by limited partners. Buying activities during the first half were quite satisfactory. This is of particular satisfaction to me since I consider the buying end to be about 90% of this business. Our general category now includes 3 companies where BPL is the largest single stockholder. These stocks have been bought and are continuing to be bought at prices considerably below their value to a private owner. We have been buying one of these situations for approximately 18 months and both of the others for about a year. It would not surprise me if we continue to do nothing but patiently buy these securities week after week for at least another year, and perhaps even 2 years or more. What we really like to see in situations like the 3 mentioned above is a condition where the company is making substantial progress in terms of improving earnings, increasing asset values, etc., but where the market price of the stock is doing very little while we continue to acquire it. This doesn't do much for our short-term performance, particularly relative to a rising market, but it is a comfortable and logical producer of longer-term profits. Such activity should usually result in either appreciation of market prices from external factors or the acquisition by us of a controlling position in a business at a bargain price. Either alternative suits me. It is important to realize, however, that most of our holdings in the general category continue to be securities which we believe to be considerably undervalued, but where there is not the slightest possibility that we could have a controlling position. We expect the market to justify our analyses of such situations in a reasonable period of time, but we do not have the 2 strings to our bow mentioned in the above paragraph working for us in these securities. Investment companies. We regularly compare our results with the 2 largest open-end investment companies, mutual funds, that follow a policy of being typically 95% to 100% invested in common stocks, and the 2 largest diversified closed-end investment companies. These 4 companies, Massachusetts Investors Trust, Investors Stock Fund, Tricontinental Corp., and Lehman Corp., manage over $4 billion and are probably typical of most of the $28 billion investment company industry. Their results are shown below. My opinion is that this performance roughly parallels that of the overwhelming majority of other investment advisory organizations which handle, in aggregate, vastly greater sums. Year Mass. INV. Trust. 1. Investors Stock. 1. Lehman. 2. Tricont. 2. Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1958 42.7% 47.5% 40.8% 33.2% 38.5% 32.2% 1959 9.0% 10.3% 8.1% 8.4% 20.0% 20.9% 1960 -1.0% -0.6% 2.5% 2.8% -6.2% 18.6% 1961 25.6% 24.9% 23.6% 22.5% 22.4% 35.9% 1960 -62 -9.8% -13.4% -14.4% -10.0% -7.6% 11.9% 1963 20.0% 16.5% 23.7% 18.3% 20.6% 30.5% First half 1964 11.0% 9.5% 9.6% 8.6% 10.9% 10.5% Cumulative results 105.8% 95.5% 98.2% 105.1% 116.1% 354.4% Annual compounded rate 10.1% 9.4% 9.6% 10.1% 10.8% 22.2% 64. 1. Computed from changes in asset value plus any distributions to holders of record during year. 2. From 1964 Moody's Bank and Finance Manual for 1957 to 63. Estimated for first half 1964. These figures continue to show that the most highly paid and respected investment management has difficulty matching the performance of an unmanaged index of blue-chip stocks. The results of these companies in some ways resemble the activity of a duck sitting on a pond. When the water, the market, rises, the duck rises. When it falls, back goes the duck. SPCA or no SPCA, I think the duck can only take the credit, or blame, for his own activities. The rise and fall of the lake is hardly something for him to quack about. The water level has been of great importance to BPL's performance, as the table on page 1 indicates. However, we have also occasionally flapped our wings. I would like to emphasize that I am not saying that the Dow is the only way of measuring investment performance in common stocks. However, I do say that all investment managements, including self-management, should be subjected to objective tests, and that the standards should be selected a priori rather than conveniently chosen retrospectively. The management of money is big business. Investment managers place great stress on evaluating company managements in the auto industry, steel industry, chemical industry, etc. These evaluations take enormous amounts of work, are usually delivered with great solemnity, and are devoted to finding out which companies are well managed and which companies have management weaknesses. After devoting strenuous efforts to objectively measuring the managements of portfolio companies, it seems strange indeed that similar examination is not applied to the portfolio managers themselves. We feel it is essential that investors and investment managements establish standards of performance and, regularly and objectively, study their own results just as carefully as they study their investments. We will regularly follow this policy wherever it may lead. It is perhaps too obvious to say that our policy of measuring performance in no way guarantees good results, it merely guarantees objective evaluation. I want to stress the points mentioned in the ground rules regarding application of the standard, namely that it should be applied on at least a 3-year basis because of the nature of our operation, and also that during a speculative boom we may lag the field. However, one thing I can promise you. We started out with a 36-inch yardstick and we'll keep it that way. If we don't measure up, we won't change yardsticks. In my opinion, the entire field of investment management, involving hundreds of billions of dollars, would be more satisfactorily conducted if everyone had a good yardstick for measurement of ability and sensibly applied it. This is regularly done by most people in the conduct of their own business when evaluating markets, people, machines, methods, etc., and money management is the largest business in the world. Taxes: we entered 1964 with net unrealized gains of $2,991,090, which is all attributable to partners belonging during 1963. Through June 30, we have realized capital gains of $2,826,248.76, of which 96% are long-term. So it appears very likely that at least all the unrealized appreciation attributable to your interest and reported to you in our letter of January 25, 1964, item 3, will be realized this year. I again want to emphasize that this has nothing to do with how we are doing. It is possible that I could have made the above statement, and the market value of your BPL interest could have shrunk substantially since January 1st, so the fact that we have large realized gains is no cause for exultation. Similarly, when our realized gains are very small, there is not necessarily any reason to be discouraged. We do not play any games to either accelerate or defer taxes. We make investment decisions based on our evaluation of the most profitable combination of probabilities. If this means paying taxes, I'm glad the rates on long-term capital gains are as low as they are. As previously stated in our most recent tax letter of April 1, 1964, the safe course to follow on interim estimate 65 is to pay the same estimated tax for 1964 as your actual tax was for 1963. There can be no penalties if you follow this procedure. The tax liability for partners who entered January 1 will, of course, be quite moderate, as it always is in the first year for any partner. This occurs because realized capital gains are first attributed to old partners having an interest in unrealized appreciation. This, again, of course, has nothing to do with economic performance. All limited partners, new and old, except for Bill Scott, Ruth Scott and Susan Buffett per paragraph 5 of the partnership agreement, end up with exactly the same results. As usual, net ordinary income for all partners is nominal to date. As in past years, we will have a letter out about November 1st, to partners and those who have indicated an interest, to us by that time in becoming partners, with the amendment to the partnership agreement, commitment letter for 1965, estimate or the 1964 tax situation, etc. In the meantime, keep Buffett Partnership, Limited.
810 Kiewit Plaza, Omaha 31. Nebraska, January 18, 1965. Our performance in 1964. Although we had an overall gain of $4,846,312.37 in 1964, it was not one of our better years as judged by our fundamental yardstick, the Dow Jones Industrial Average, hereinafter called the Dow.
The overall result for BPL was plus 27.8% compared to an overall plus 18.7% for the Dow. The overall result for limited partners was plus 22.3%. Both the advantage of 9.1 percentage points on a partnership basis and 3.6 points by the limited partners were the poorest since 1959, which was a year of roughly comparable gains for the Dow. Nevertheless, I am not depressed. It was a strong year for the general market, and it is always tougher for us to outshine the Dow in such a year. We are certain to have years when the Dow gives us a drubbing and, in some respects, I feel rather fortunate that 1964 wasn't the year. Because of the problems that galloping markets pose for us, a Dow repeat in 1965 of 1964 results would make it most difficult for us to match its performance, let alone surpass it by a decent margin. To bring the record up to date, the following summarizes the year-by-year performance of the Dow, the performance of the partnership before allocation to the general partner, and the limited partner's results. Year overall results from Dow. 1. Partnership results. 2. Limited partners results. 3. 1957. 8.4%, 10.4%, 9.3%, 1,958, 38.5%, 40.9%, 32.2%, 1,959, 20.0%, 25.9%, 20.9%, 1,960-6.2%, 22.8%, 18.6%, 1,961, 22.4%, 45.9%, 35.9%, 1,962 minus 7.6%, 13.9%, 11.9%, 1,963, 20.6%, 38.7%, 30.5%, 1,964, 18.7%, 27.8%, 22.3%. 1. Based on yearly changes in the value of the Dow plus dividends that would have been received through ownership of the Dow during that year. The table includes all complete years of partnership activity. 2. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout the entire year after all expenses, but before distributions to partners or allocations to the general partner. 3. For 1957 to 61 computed on the basis of the preceding column of partnership results allowing for allocation to the general partner based upon the present partnership agreement, but before monthly withdrawals by limited partners. On a cumulative or compounded basis, the results are: year overall results from Dow Partnership Results Limited Partners Results 1957 -8.4%, 10.4%, 9.3%, 1957 58 26.9%, 55.6%, 44.5%, 67 1957 59 52.3%, 95.9%, 74.7%, 1957 to 60 42.9%, 140.9%, 107.2%, 1957 61 74.9%, 251.0%, 181.6%, 1957 62 61.6%, 299.8%, 215.1%, 1957 63 94.9%, 454.5%, 311.2%, 1957 to 64 131.3%, 608.7%, 402.9%, annual compounded rate 11.1%, 27.7%, 22.3%. Investment companies. We regularly compare our results with the two largest open-end investment companies, mutual funds, that follow a policy of being typically 95 to 100% invested in common stock, and the two largest diversified closed-end investment companies. These four companies, Massachusetts Investors Trust, Investors Stock Fund, Tricontinental Corporation, and Lehman Corporation, manage about $4.5 billion, are owned by about 550,000 shareholders, and are probably typical of most of the $30 billion investment company industry. My opinion is that their results roughly parallel those of the overwhelming majority of other investment advisory organizations which handle, in aggregate, vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index of investment achievement. The advisory talent managing just the four companies shown commands annual fees of over $8 million, and this represents a very small fraction of the professional investment management industry. The public batting average of this highly paid and widely respected talent indicates performance a shade below that of the Dow, an unmanaged index. Yearly results. Year Mass. INV. Trust. 1. Investors Stock. 1. Lehman. 2. Tricont. 2. Dow Limited Partners 1957 -11.4%, -12.4%, -11.4%, -2.4%, -8.4%, 9.3%, 1958 42.7%, 47.5%, 40.8%, 33.2%, 38.5%, 32.2%, 1959 9.0%, 10.3%, 8.1%, 8.4%, 20.0%, 20.9%, 1960 -1.0%, -0.6%, 2.5%, 2.8%, -6.2%, 18.6%, 1961 25.6%, 24.9%, 23.6%, 22.5%, 22.4%, 35.9%, 1962 -9.8%, -13.4%, -14.4%, -10.0%, -7.6%, 11.9%, 1963 20.0%, 16.5%, 23.7%, 18.3%, 20.6%, 30.5%, 1964 15.9%, 14.3%, 13.6%, 12.6%, 18.7%, 22.3%. 1. Computed from changes in asset value plus any distributions to holders of record during year. 2. From 1964 Moody's Bank and Finance Manual for 1957 to 63. Estimated for 1964. Compounded year mass. INV. Trust. 1. Investors stock. 1. Lehman. 2. Tricont. 2. Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1957 58 26.4% 29.2% 24.7% 30.0% 26.9% 44.5% 1957 59 37.8% 42.5% 34.8% 40.9% 52.3% 74.7% 1957 to 60 36.4% 41.6% 38.2% 44.8% 42.9% 107.2% 68 1957 6171.3% 76.9% 70.8% 77.4% 74.9% 181.6% 1957 62 54.5% 53.2% 46.2% 59.7% 61.6% 215.1% 1957 to 63 85.4% 78.5% 80.8% 88.9% 94.9% 311.2% 1957 to 64,114.9% 104.0% 105.4% 112.7% 131.3% 402.9% annual compounded rate 10.0% 9.3% 9.4% 9.9% 11.1% 22.3%. The repetition of these tables has caused partners to ask, why in the world does this happen to very intelligent managements working with 1. Bright, energetic staff people, 2. Virtually unlimited resources, 3. The most extensive business contacts, and 4. Literally centuries of aggregate investment experience? The latter qualification brings to mind the fellow who applied for a job and stated he had 20 years of experience, which was corrected by the former employer to read 1 year's experience 20 times. This question is of enormous importance, and you would expect it to be the subject of considerable study by investment managers and substantial investors. After all, each percentage point on $30 billion is $300 million per year. Curiously enough, there is practically nothing in the literature of Wall Street attracting this problem, and discussion of it is virtually absent at Security Analyst Society meetings, conventions, seminars, etc. My opinion is that the first job of any investment management organization is to analyze its own techniques and results before pronouncing judgment on the managerial abilities and performance of the major corporate entities of the United States. In the great majority of cases, the lack of performance exceeding or even matching an unmanaged index in no way reflects lack of either intellectual capacity or integrity. I think it is much more the product of 1. Group decisions. My perhaps jaundiced view is that it is close to impossible for outstanding investment management to come from a group of any size with all parties really participating in decisions. 2. A desire to conform to the policies and, to an extent, the portfolios of other large well-regarded organizations. 3. An institutional framework whereby average is safe, and the personal rewards for independent action are in no way commensurate with the general risk attached to such action. 4. An adherence to certain diversification practices which are irrational. And finally and importantly, 5. Inertia. Perhaps the above comments are unjust. Perhaps even our statistical comparisons are unjust. Both our portfolio and method of operation differ substantially from the investment companies in the table. However, I believe both our partners and their stockholders feel their managements are seeking the same goal: the maximum long-term average return on capital obtainable with the minimum risk of permanent loss consistent with a program of continuous investment in equities. Since we should have common goals, and most partners, as an alternative to their interest in BPL, would probably have their funds invested in media producing results comparable with these investment companies, I feel their performance record is meaningful in judging our own results. There is no question that an important service is provided to investors by investment companies, investment advisors, trust departments, etc. This service revolves around the attainment of adequate diversification, the preservation of a long-term outlook, the ease of handling investment decisions and mechanics, and most importantly, the avoidance of the patently inferior investment techniques which seem to entice some individuals. All but a few of the organizations do not specifically promise to deliver superior investment performance, although it is perhaps not unreasonable for the public to draw such an inference from their advertised emphasis on professional management. One thing I pledge to you as partners. Just as I consider the previously stated performance comparison to be meaningful now, so will I in future years, no matter what tale unfolds. Correspondingly, I ask that you, if you do not feel such a standard to be relevant, register such disagreement now and suggest other standards which can be applied prospectively rather than retrospectively. 69. One additional thought. I have not included a column in my table for the most widely used investment advisor in the world, Bell Management. People who watch their weight, golf scores, and fuel bills seem to shun quantitative evaluation of their investment management skills, although it involves the most important client in the world, themselves. While it may be of academic interest to evaluate the management accomplishments of Massachusetts Investors Trust or Lehman Corporation, it is of enormous dollars and cents importance to evaluate objectively the accomplishments of the fellow who is actually handling your money, even if it's you. The question of conservatism in looking at the table of investment company performance, the question might be asked. Yes, but aren't those companies run more conservatively than the partnership? If you asked that question of the investment company managements, they, in absolute honesty, would say they were more conservative. If you asked the first 100 security analysts you met, I am sure that a very large majority of them also would answer for the investment companies. I would disagree. I have over 90% of my net worth in BPL, and most of my family have percentages in that area, but of course, that only demonstrates the sincerity of my view, not the validity of it. It is unquestionably true that the investment companies have their money more conventionally invested than we do. To many people, conventionality is indistinguishable from conservatism. In my view, this represents erroneous thinking. Neither a conventional nor an unconventional approach, per se, is conservative. Truly conservative actions arise from intelligent hypotheses, correct facts, and sound reasoning. These qualities may lead to conventional acts, but there have been many times when they have led to unorthodoxy. In some corner of the world they are probably still holding regular meetings of the Flat Earth Society. We derive no comfort because important people, vocal people, or great numbers of people agree with us. Nor do we derive comfort if they don't. A public opinion poll is no substitute for thought. When we really sit back with a smile on our face is when we run into a situation we can understand, where the facts are ascertainable and clear, and the course of action obvious. In that case, whether other conventional or unconventional, whether others agree or disagree, we feel we are progressing in a conservative manner. The above may seem highly subjective. It is. You should prefer an objective approach to the question. I do. My suggestion as to one rational way to evaluate the conservativeness of past policies is to study performance in declining markets. We have only 3 years of declining markets in our table, and unfortunately, for purposes of this test only, they were all moderate declines. In all 3 of these years we achieved appreciably better investment results than any of the more conventional portfolios. Specifically, if those 3 years had occurred in sequence, the cumulative results would have been Tri-Continental Corp. minus 9.7%, Dow minus 20.6%, Mass. Investors Trust minus 20.9%, Lehman Corp. minus 22.3%, Investors Stock Fund minus 24.6%, Limited Partners plus 45.0%. We don't think this comparison is all important, but we do think it has some relevance. We certainly think it makes more sense than saying, we own, regardless of price, AT&T, General Electric, IBM and General Motors and are therefore conservative. In any event, evaluation of the conservatism of any investment program or management, including self-management, should be based upon rational objective standards, and I suggest performance in declining markets to be at least one meaningful test. 70. The joys of compounding. Readers of our early annual letters registered discontent at a mere recital of contemporary investment experience, but instead hungered for the intellectual stimulation that only could be provided by a depth study of investment strategy spanning the centuries. Hence, this section. Our last two excursions into the mythology of financial expertise have revealed that purportedly shrewd investments by Isabella, backing the voyage of Columbus, and Francis I, original purchase of Mona Lisa, bordered on fiscal lunacy. Apologists for these parties have presented an array of sentimental trivia. Through it all, our compounding tables have not been dented by attack. Nevertheless, one criticism has stung a bit. The charge has been made that this column has acquired a negative tone, with only the financial incompetence of history receiving comment. We have been challenged to record on these pages a story of financial perspicacity which will be a benchmark of brilliance down through the ages. One story stands out. This, of course, is the saga of trading acumen etched into history by the Manhattan Indians when they unloaded their island to that notorious spendthrift, Peter Minuit, in 1626. My understanding is that they received $24 net. For this, Minuit received 22.3 square miles, which works out to about 621,688,320 square feet. While on the basis of comparable sales, it is difficult to arrive at a precise appraisal, a $20 per square foot estimate seems reasonable given a current land value for the island of $12,433,766,400, $12.5 billion. To the novice, perhaps this sounds like a decent deal. However, the Indians have only had to achieve a 6.5% return. The tribal mutual fund representative would have promised them this. To obtain the last laugh on Minuit. At 6.5%, $24 becomes $42,105,772,800, $42 billion, in 338 years. And if they just manage to squeeze out an extra half point to get to 7%, the present value becomes $205 billion. So much for that. Some of you may view your investment policies on a shorter-term basis.
For your convenience, we include our usual table indicating the gains from compounding $100,000 at various rates. 4%, 8%, 12%, 16%, 10 years, $48,024, $115,892, $210,584, $341,143, 20 years, $119,111, $366,094, $864,627, $1,846,060, 30 years, $224,337, $906,260, $2,895,970, $8,484,940. This table indicates the financial advantages of 1. A long life. In the erudite vocabulary of the financial sophisticate, this is referred to as the Methuselah technique. 2. A high compound rate. 3. A combination of both, especially recommended by this author. To be observed are the enormous benefits produced by relatively small gains in the annual earnings rate.
This explains our attitude, which, while hopeful of achieving a striking margin of superiority over average investment results, nevertheless regards every percentage point of investment return above average as having real meaning. Our goal 71. You will note that there are no columns in the preceding table for the 27.7% average of the partnership during its 8-year lifespan or the 22.3% average of the limited partners. Such figures are nonsensical for the long term for several reasons. Don't worry about me holding back to substantiate this prophecy. 1. Any significant sums compounded at such rates take on national debt proportions at alarming speed. 2. During our 8-year history, a general revaluation of securities has produced average annual rates of overall gain from the whole common stock field which I believe unattainable in future decades. Over a span of 20 or 30 years, I would expect something more like 6% to 7% overall annual gain from the Dow instead of the 11.1% during our brief history. This factor alone would tend to knock 4 points or so off of our annual compounding rate. It would only take a minus 20.5% year in 1965 for the Dow to bring it down to a 7% average figure for the 9 years. Such years, or worse, should definitely be expected from time to time by those holding equity investments.
If a 20% or 30% drop in the market value of your equity holdings, such as BPL, is going to produce emotional or financial distress, you should simply avoid common stock-type investments.
In the words of the poet, Harry Truman, if you can't stand the heat, stay out of the kitchen.
It is preferable, of course, to consider the problem before you enter the kitchen. 3. We do not consider it possible on an extended basis to maintain the 16.6 percentage point advantage over the Dow of the partnership or the 11.2 percentage point edge enjoyed by the limited partners.
We have had 8 consecutive years in which our pool of money has outperformed the Dow, although the profit allocation arrangement left the limited partners short of Dow results in one of those years. We are certain to have years, note the plural, when the partnership results fall short of the Dow despite considerable gnashing of teeth by the general partner, I hope not too much by the limited partners. When that happens, our average margin of superiority will drop sharply. I might say that I also think we will continue to have some years of very decent margins in our favor. However, to date we have